We start off with what has been a very rough week for the markets. While the S&P eked out a gain today, it's still finished down almost 6% since Monday. Its worst 5-day stretch since the start of the pandemic. The Dow clocking its 11th weekly loss in 12, the first time it has ever done that. And the longtime winners have suddenly dramatically become the losers, with oil prices plunging 10% this week. Energy stocks accounted for the 12 worst performers in the S&P. Coterra, EOG, Devon among the names that were down more than 20%. All of these names hit 52-week highs just last week. So could breaking the energy fever become a tailwind for a rip higher? Tim, what do you say?
It can be part of it. I think today's rally was almost, unfortunately, a recessionary rally in bonds. Lower interest rates was something that gave equities the sense that actually we're in a better place. Look at what rallied today. You saw consumer discretionary rally. You saw high multiple tech rally. Those, to me, are the most sensitive to the dynamics here. But there's no question today was about oil. And the sell-off in oil prices, I get it. I'm not changing my tune. I think energy prices structurally have to stay higher. I think we all, well, I won't speak for everybody. I'll say I think the Biden administration's approach to energy policy is part of the reason we got here. I think some of the charade this week around what we're going to do to oil companies and how we're going to limit exports and whatnot, I don't think are the real story. I actually think we could probably solve some of this internally. But the structural dynamics and the China reopening dynamics and some of the things that I think have kept supply tight, even in a demand, let's focus on demand. Recession today was kind of the story for the bond market. It could have been for oil, but it's really about supply. That's what's going to keep oil prices elevated here. And I do think you have an opportunity.
I guess it depends, Steve Grasso, on why you think oil prices are going down. And if it is a recession, that's sort of counterintuitive in terms of it being a tailwind for stocks.
Yeah, so I think it's a process. First of all, I'll echo Tim's words on the administration and their poor handling of the energy complex leading up to this, way before we even had any of these issues. They were just festering. That's number one. Two, I think the energy prices are, those are the real-time data points, Melissa. If the market was reacting off of CPI, and maybe we are at peak inflation, but if we're worried about a recession, that's why the energy prices plummeted. If you have energy prices plummeted, it's a process. So you start to have money coming out of energy, coming out of the entire market, and then running back into the market as a whole. Not a one-day thing, not something that's going to happen tomorrow. I think the market is capable of bouncing, but I think the bounces will be short-term, and I think people are digesting recession.
This says Mr. Recession, by the way. The guy who thinks there's a recession in the cards. Courtney, you know, what do you make of this bear market bounce, let's call it that, for now, and this decline in energy?
Yeah, I think the decline in energy, I mean, it's had such a run up. I think seeing some sort of a pullback right now is really getting overshadowed with the other macroeconomic factors that are overweighing the markets right now. But ultimately, when you look at the fundamentals, the supply and demand constraint is not going to end, just to Tim's point here. And especially as we're not getting energy out of Russia, China's reopening, there's a lot more demand going in.
Libyan oil is off the market, too. It's another 1 million barrels.
Mm-hmm. Exactly. Yeah, so I would actually look to buy this dip in energy. I think that'll likely continue to be your best performing asset by the end of the year here. So just buying this dip is a better opportunity than anything else.
Jeff, would you be with Courtney in that in terms of buying the dip of energy? But if you do think that there is going to be an economic slowdown, I mean, I guess you do have to believe that the supply side, you know, the supply element of the energy equation is going to remain very tight.
That's been my story the entire time, because I've also been saying that we're going into a slowdown. The probability of a recession is high, but I've also been saying stick with the energy trade. We have pointed out numerous times that it was consensus, it was overbought. I think the XLE was, 25, 30% above its 200-day moving average. And then this week, you kind of had this perfect storm of political headlines, a sell what you can environment. And just for perspective, the XLE is still 10% above the 200-day. So you could certainly have more downside. But I agree. I mean, there's the no spare capacity issue stays with us. The China demand coming back online, I think, maybe offset some of the demand destruction you see either here in the U.S. or in Europe. And I think about a stock like ExxonMobil here trading at 9 times forward. And I think it was maybe 2 or 3 weeks ago we had Paul Sankey on talking about energy and the oil markets. And he said, ExxonMobil's forecast to have, I think, about $10 earnings per share next year. He sees upside up to $14. So for me, risk reward, that potential upside at this valuation, I think you want to lean into the sell-off.
Here's another dynamic, and that's a strong dollar. I mean, the Dixie move today was staggering. It's up 1% in a single day. And part of that is Powell. His unconditional commitment to price stability is a de facto strong dollar policy, Tim.
And some of it is the absurdity of other central banks, I think. And this week we had the BOJ, who's still targeting the short end of the curve in 25 basis points. They're so far behind on inflation. For folks that don't know what the composition of the dollar basket is, it's about 60% euro, another 20% dollar yen, and the rest is smattering, including the Swiss franc and whatnot. But the most important thing is our Fed ahead of other central banks? That will be dollar policy. I'll just say this. Strong dollar is certainly a help to CPI. It's not going to be great for earnings, but for the headwinds that consumers face, especially on import prices, it's actually very good. And I'll say this for stocks overall. Look, whenever we feel that CPI is really coming down, and I don't think it's really coming down, even on a day when we had this kind of a move in energy, stocks are going to soar. And the problem is that if you look at the history of recessions and some of the inflation bouts we've had in our country, we've all gotten pretty good at looking at 94, 95, 79, 80, 84, 85, 80 through 83 to 84. You can see that these bear market CPI dynamics. I was reading a great piece by Rich Ross at Evercore, right, where he points out the duration of that type of a market bear rally when it's a CPI-driven recession is probably 18 months. So that's the troubling thing about the market's move here. We all look at absolute levels of where the market is sold off. It just doesn't feel like we put in the timeline to actually say that we've had the kind of move, and I don't think we have, unfortunately. I think we're going to get these opportunities to trade this market, but I don't think we're there.
Courtney, materials also saw a pretty stark pullback over the past 5 days or so. Are you a buyer also of materials in the same way that you are of energy?
I am. I focus more on energy than materials. I do think you're starting to see some of that come down, which is really helpful on the inflation front. I think energy likely has a lot more of that supply-demand issue than some of your materials do. So I'd actually focus more on energy.
Yeah, Grasso?
Yeah, I think everything is coming down, Melissa. You're talking to Mr. R here. So I think that you're going to see anywhere from lumber to steel to oil. Remember my $65 a barrel oil by December of this year. I'm sticking with that. I think you're going to see sub $100 barrel oil, and I think it's going to take the entire complex with it. And then we'll see where everything flushes out in the next month or two.
Sounds like buy equities then. I mean,
down 50%.
Well, I think there's going to be a...
Yeah, Steve, go ahead. I'm just curious because with that view on commodities and inflation.
Sure. Yeah, I think it's going to be a phase, as I said from the start. So I think you're going to see all of these commodities come in pretty hard, and then you're going to see people get really frightened, sit on their hands, and then digest it. And then I would say going into the back end of the year, you're going. Remember, guys, we have midterm elections coming. Strange things happen. Politicians say anything to get votes on both sides of the aisle. So I think the back half of the year, we're going to see a market rally. I just think it's going to be very choppy for the next 2 or 3 months.
Okay, so Jeff Mills, this is where we play this game where we tell you what the outcome is going to be. You tell us, guess what the price action would be. So Steve's scenario is true. Oil goes down 50% from where it is today. Is that a good thing or a bad thing for equities? Because one could argue both sides very easily.
Yeah, I think generally speaking, it would be a bad thing for equities because it means we're going into an economic slowdown. And one of the things that the market has not digested at all yet is demand destruction and earnings revisions coming down. It's been all PE compression. That's kind of typical. If you go back to 2008, PEs came way in, then earnings came down. 2020, same thing. PEs came way in, then earnings came down. Earnings have not budged. So in that scenario, earnings are going to come down a lot, and the market's going to have to digest that. Just for a little bit of a nuanced take, I think in that market, and maybe a little bit to Tim's point, where you want to be on a relative basis, I think that's when you continue to lean into growth, technology, et cetera, because if there is any inkling that inflation is coming down and the Fed is going to back off, that part of the market where Ps have compressed more and where the earnings are somewhat more insulated from the cyclicality of the economy, I think that does relatively better.